Hey traders, welcome back to another YouTube video. So as you can see here, I'm at Grindelwald, such a beautiful part of Switzerland. And today's topic, I'm going to talk about what are the three main reasons that majority fail in trading. If it's a little bit too bright here, I'm sorry for that. So you see, most traders fail in trading. If we talk about statistics, there's about 90 to 95% failure rate in trading, or even more. Some say there's only 1% that make it to successful trading, to consistent trading. But have you all ever wondered what are the common reasons that people fail? And here are top 3 reasons. So just a summary. The first one, you have the urge to control the uncontrollable. That's our first point. If you are someone who's having an extreme ego or being extremely stubborn with your bias, with your mindset, with your thesis, your analysis, then you might get caught. You might get caught a lot of times just being stubborn on the market, being way too biased, and you just keep revenge trading. All right, so you see, market is probably one of the things that are ever changing every single day. One example I like to use in our trade club is today gold can be in 100 pips wide range. It can push 100 pips to the upside. Tomorrow it can drop 300 pips to the downside, and the next day it can be in a 15 pips range, and the following week it can be just in a complete dead market, moving sideways, being so choppy. So if you can't control the market, what can you exactly control? Your mindset, your system, the way you manage your position, the way you control your emotion. That's it. Most traders are always stuck in a loophole where they keep on revenge trade, over trade, over risk, over leveraging. These are just pure reflection of your internal self. If you are someone who are extremely indisciplined, you can never make it in trading, because trading doesn't just require you to become a good trader, a disciplined trader. It also requires you to be someone who's extremely disciplined and also flexible at the same time. Okay, so first point, which is you are always trying to control the things that you cannot control. If the market condition is slow, drop your expectation. If the market condition is quick, increase your expectation, which leads us to our second point, which is most traders are not flexible enough. Right? So flexibility doesn't mean you just swing your positions, flip between long and short at the same time. Flexibility means, are you able to detect, to sense that something is changing in the market? One example, if let's say today market is going up, the range is beautiful, volume is there, the next day, are you able to detect or identify that if the market is going to continue pushing up aggressively, or is it going to slow down a little bit? We can't predict the market, but what you can do is you have a strict game plan, you have a strict filtering process to help you to identify, hey, yesterday was a wide range. Is it possibly that today is still going to be a wide range? Maybe not. Yesterday market was slowing down. Today is likely to be a slow day as well. Okay, so again, good trading, successful trading is about being aggressive and defensive at the same time. It's one of the best quote. I forgot who's the author, but it's one of the best quote that I know. Remember, being aggressive as in when you know that the market is offering great opportunity, you need to push harder. You need to risk a little bit more. Most traders, most guru on the YouTube, on the internet, they tell you something like, have a consistent risk, have a 1% risk. But if you really look at some of the best top traders, 7-8 figures trader, some of the prop firm trader, I'm not talking about online prop firms, I'm talking about floor trader, some of the best hedge fund manager, do you think they risk so-called 1% static risk across every single opportunity? No, There are times where the market is offering you great opportunities, A plus quality setups. Those are setups where you have to risk a little bit more. By risking more, I'm not asking you to go all in, but for example, like myself, I have a linear risk per trade system. I have enough data to tell myself, hey, this setup is A plus quality, this setup is A quality or A minus quality, this setup is B quality. So once I'm able to categorize them, it just helps me a lot in identifying which setups requires the most attention. Once I know that setup requires a lot of attention, I know if it starts going into according to my plan, according to my game plan, I need to add more size along the way. That's how I've been able to generate 1 to 5, 1 to 10, 1 to 20 risk reward trade on certain occasion. That's not because I was lucky. That's because I have a system. I have the proper approach to deal with different situations. All right, risking a static 1% risk per trade or just static risk across all your setups are something that is suitable for beginner or a lazy trader. Because if you are a beginner, high chance you don't know how to categorize or identify what are good or some of the bad opportunities. If you can't separate what are some of the good versus bad opportunities, obviously you're going to lose money over the long term. So therefore, I will suggest you to have a static risk per trade. In that way, your performance can be a little bit more consistent across the board. But if you today have experience, if you have enough data collected in the market, if you know under which season, which market condition, which specific criteria does your system works the best, that's the time you need to start leveling up your game. By leveling up your game means you start risking more on high quality setups. So just now on the second point, we talk about we talk about flexibility, and I talked about aggressive mode. Let's talk about defensive mode. Most traders are not able to play defense on a poor market condition. I'll give you some example. If you look at your overall performance, you'll realize that a lot of times you're over trading or over risking on poor market condition. Poor market condition, there's only one thing, which is slow market. When market is slow, there is no opportunity. Some traders will argue that when the market is ranging, you trade the range, but you can't treat them the same way. When the market is expanding, or what we call in a volatility expansion, when it's on a high volume day, when it's moving for 200, 300 pips, keep moving higher or lower, obviously those are setups that you're going to make the most money. There's no way you can make the most money on a dead market. If the market is on a 15 pips range, some will say just buy support, sell resistance. But the main thing is, in a range, ask yourself, look at your journal. There are a lot of times where the market just fake out the highs, fake out the lows, chop in between, just chop sideways for multiple days. You can't make money on that kind of market. So your job is to be able to rectify when the market is starting to show signs of slowing down. Then you trade less and you risk less, or you don't trade at all. All right. So that's our first point. That's our second point. First point, we talk about most traders are trying to control the uncontrollable factors, which is the market. Second point, we talk about traders are not being flexible enough. Now, third point is traders have unrealistic expectation. So I am not like the typical gurus that will tell you, oh, set realistic target like 5 to 10% per month. On good months, I may make 20 to 25% or 30%. But it all depends on your capital size as well. As your capital grows, obviously you risk a little bit lesser, because there is just no point to risk that much. So let's say today you have a capital for 100K. For you to risk 2% per trade is still fine, $2,000. But let's say if today your capital is $1 million, for you to risk 2%, that's $20,000. And realistically speaking, do you need to risk $20,000 to make good money? Not really. Sometimes you only need to risk 0.5% on $1 million account. That's already $5,000. What I'm trying to say here, your expectation has a direct correlation, has a direct link with your capital size. People with the highest expectation are those that with smaller account. And that's why if you're having a smaller account right now, I won't tell you you have to risk less, but what I can tell you is risk an amount that you think there is no way, if anything go wrong, you could possibly blow your account. And that's so important. A lot of traders, they miscalculate their risk. They don't know how to adjust their risk, and they end up just blow their account just because they're trying to flip their account. But it doesn't work that way. Market don't care if you want to flip 10k to 100k. Market don't care if you want to flip $100 to $10,000. Market just don't give a damn. And all of you to understand, if right now you are newer to the market, or if you're an advanced trader, you're an experienced trader, realistic expectation means set target that has proven to be achievable. For example, if last year you were able to make an average of 10% per month, so next year you can actually start setting target and say, I want to make average 11 to 12% a month. Don't look down on this small 1 to 2% average increment over the year. Let's say your average is 10% a month. If you're able to increase to 11% a month on average, that's already extra 12% per year. Right? Makes sense? Set realistic target, set realistic expectation that is proven to be achievable. Don't set a realistic expectation that is not achievable, such as if right now you're making $10,000 a month, next year you say, I want to make $1 million a month. No, impossible. Market don't care about what you think, because there's no way you can do it. All right, so that's pretty much it for this video. I hope all of you understand this. Just a quick summary. First point, we talk about avoid trying to control the uncontrollable factors. Second point, we talk about flexibility, being able to be aggressive and defensive at the same time. And third point, we talk about expectations. Setting expectations right will get you just such a more calm, a more peaceful mindset. All right, so that's it for the video. If you like it, please don't forget to like and subscribe, and I hope all of you enjoy the background view. I'll talk to you in the next video. Bye bye.